Hello, my name is Andrew Tiartstra, editor of Professional Broking magazine. In these gloomy economic times, I am joined in the studio by one of ACE's senior managers, Patrick Drynan, who is UK Development and Distribution Manager for UK and Ireland. He wants to give broker managers a market insight into how to look after their clients in these challenging times, and also about the state of the insurance market in 2009, looking forward to 2010. Patrick, welcome to the studio.
Thank you, Andrew.
I want to start by asking about the recession. Clearly, we're in the middle of a deep recession. What do you believe are the main challenges for insurers for the rest of the year?
Well, looking ahead and looking at the outcome for the outlook for 2009, one thing we can be sure of is there's going to be quite a lot more of uncertainty. But there are some things we do see happening already. We're seeing quite a bit of capital destruction. We're seeing as we speak, we see fourth quarter results from a lot of insurance companies, and in those results we see investment losses, losses and capital destruction on the asset side of the balance sheet through devaluation of assets, through falling stock markets, through frozen capital markets. And that's a trend we're likely to see continue for a little while longer. We're also seeing some capital destruction on the underwriting side of the business. We've seen 5 years of soft market underwriting, reduction in prices. We've seen above average catastrophe losses. And now we're seeing insurers' results being posted that show combined loss ratios of 100 and above. And that's before you strip out the effects of prior year reserve releases. So those insurers are facing into 2009 with loss-making books of business. Clearly, that will destroy capital. Now, reduced capital leads to reduced capacity, and you would expect a reduced supply of insurance will lead to increased pricing. But there are some factors in the marketplace that will present challenges for us in the year ahead. And we don't know how these will develop yet and what the implications will be for our industry. There's a contraction in the economy, and this could lead to the overall demand for insurance actually decreasing. Now, so even as we're raising rates, that may not translate into top-line premium growth because exposures come down. Now, whilst insurance is a necessity for a lot of companies, nonetheless, they will look to cut their costs and cut the expenditure on insurance. So does that mean there's less exposure? Sometimes they will look to increase retentions. Maybe they'll look at alternative ways of risk funding mechanisms. So it may be that some companies loosen their financial rating criteria, and they may decide to do business with more financially distressed insurance companies. A notable challenge for the industry will be how diligently insurance companies adhere to underwriting discipline in the next year to 2 years, especially financially distressed carriers. And of course, we have to keep a close eye on what's happening to claims trends. Claims trends of recent years will not, we cannot assume they're going to be the same in a more economically challenging environment. So yes, it's going to be, we do know certain things about the next year to 2 years in the way of capital destruction, in the way of the need for pricing to increase and hardening of the market. But at the same time, there are challenges, there are factors that challenge that marketplace. And so we don't know how they'll play out yet, but certainly it will be an interesting time.
As you've mentioned, clearly businesses are suffering and possibly looking at cutting back on their insurance expenditure. Arguably, the role of the broker is more important than ever. Would you agree, and what advice do you have for brokers?
Well, the wise brokers have been shaping their businesses to face these challenges for quite a while. They've been preparing their clients. Their business models are client-focused. They're lean. and they've been nurturing relationships with financially secure insurance companies for quite a while now. The recessionary times will have an impact on clients and will ultimately have an impact on the insurance brokers. If there are less goods manufactured, clearly there'll be less need for marine insurance. If there are less construction activity, there'll be less need for construction insurance. But risk doesn't go away, and weaker insureds are more vulnerable in troubled times to risk. Therefore, many companies will in fact need more advice from their insurance brokers as they struggle to contain costs, manage risks, and get more value for money, especially from their insurance program. In a hardening market, premiums generally go upwards, but it's important that clients and their brokers still maintain focus on identifying risk, on mitigating it, eliminating risk, and transferring the remains to the insurance companies. I think there is a danger of people losing sight of new and emerging exposures when they're faced with the pressures to reduce cost and reduce expenditure on insurance. In the wake of recession, it's generally accepted we're going to be in a busier regulatory environment. In the UK this year, there's a new European Union directive becomes law for pollution. So, recession or no recession, if a company falls foul of that new EU directive, they will suffer the full wrath of that law regardless. And equally, a company facing pressures, cash flow pressures, cannot become careless about their IT system securities. Because we know in times of recession, the incidence of fraud will increase. So in these new areas of exposure, I think there is more opportunity for the insurance brokers to give advice to their clients. And of course, like all other businesses, insurance brokers have to run their business. So I think it will be difficult to increase revenue, possibly, for the insurance brokers, and they'll have an eye on protecting their margins. But it'll be interesting to see the various business models that were generated in the soft market and how they cope with reducing costs and increasing productivity and increasing efficiencies. But in the end, the basic ingredients of broker success haven't changed because of the downturn. And I think those brokers that have prepared their clients, have a good understanding of their clients' needs, have lean, client-focused business models, and have strong relationships with insurance companies, financially secure insurance companies, I think those companies might actually see opportunities, and I think they'll do really well in the next couple of years.
Okay, thank you. And there is some evidence of hardening rates. Can you tell me which sectors they're in and what the outlook is for the rest of 2009 and going into 2010?
Yes, I do see evidence of some hardening in the rates. As we discussed earlier on, insurers are hurting from 5 years of soft market underwriting, reducing prices, cost inefficiencies and poor investment returns. Specifically in terms of which sectors, at ACE we've seen hardening in some segments of our D&O business. Some parts of our energy business have started to see rate increases driven by losses in that industry sector, and indeed our aviation business has started to see rate improvement. In the UK and Ireland at the back end of 2008, our core P&C lines saw rate flattening, and indeed some accounts achieved rate increases. So there's good momentum coming into 2009. Now, although we're seeing rate increase, it's not necessarily going to translate immediately or automatically into increased premiums, because the other side of that coin is that we're facing a recession, and that means less exposure. Less exposure means less insurance premium. So one thing we can say for definite is that the rate increase does imply improved margin, and so this is very good news for those insurance companies that are focused on underwriting profits. but maybe not so good for those insurance companies that are focused on top-line premium growth. So, yes, I do see evidence of rate firming. I don't see that trend stopping. In fact, if anything, I see it continuing for the rest of this year and accelerating through the end of the year.
Thank you, Patrick. My final question is about your company, ACE. How is it coping with the current economic challenges?
ACE is coping really well, Andrew, as demonstrated by our 2008 results, where we posted a P&C combined loss ratio of 89.6%. And this, of course, is a reflection of the support we get from our partner insurance brokers. These are risky times, but risk is our business. I'm very optimistic about this year for ACE in the UK and Ireland. Our balance sheet is in great shape. We're so well positioned in terms of not just our financials and our presence, but the talent we have and our positioning in the marketplace and our reputation. As well as our core P&C products, we continue to respond to new and emerging risks and sectors like the renewable energy sector, cyber liability, and the needs of companies that are expanding abroad through our recently launched ACE Evolve product. In these challenging economic times, we also help our brokers to grow their business by investing in new distribution channels like our ACE Online product, which is market leading and helps our insurance brokers to transact large volumes of specialty business online in a very cost-effective manner. In terms of service delivery, we have tremendous capability. Through the end of January 2009, ACE in the UK had issued all of its policies, bar 5, for UK-based risks, and that was at an accuracy rate of 98.7%. That's a tremendous benchmark for us to move on from and improve on in 2009. So ACE has a very strong global franchise. It's world-class balance sheet. We have a great product portfolio and really strong broker relationships. Add to that the strength of our underwriting talent, our claims adjusters, and our support staff, which are second to none. So in these uncertain times, more and more clients and brokers recognise those capabilities in ACE and recognise and see the core qualities of strength, stability and service in what we offer.
Thank you, Patrick.
Thanks, Andrew.
Thank you for watching.